Ladies and gentlemen, good day and welcome to Go Fashion India Limited Q3 and 9 months FY26 earnings conference call. Before we begin, I would like to remind participants that this conference call may contain forward-looking statements which are based on the beliefs, opinions, and expectations of the company as of today. These statements are not the guarantees of the future performance and involve risks and uncertainties that are difficult to predict. As a reminder, all participants' line will be in listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during this conference call, please signal an operator by pressing star then 0 on your touch-tone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Gautam Saraogi, promoter and CEO of Go Fashion India Limited. Thank you, and over to you, sir.
Good evening and a warm welcome to everyone present on the call. I have along with me Mr. R. Mohan, our Chief Financial Officer, and SGA, our Investor Relations Advisors. I hope you have all received our investor deck by now. For those who have not, you can view it on the stock exchange and the company website. Q3 has been a challenging quarter for the apparel industry, mainly due to lower footfalls. During Q3 FY26, revenue stood at 194 crores with gross margins of 64.3%. EBITDA stood at rupees 52 crores and PAT stood at rupees 7 crores. However, the company has demonstrated resilience in its core operational fundamentals such as full price sales ratio, items per transaction, and customer conversion rates, which have remained stable, reflecting continued consumer relevance and disciplined execution. The overall retail environment remains subdued with discretionary consumption witnessing moderation across categories. Factors such as uneven festive demand, selective consumer spending, and lower footfalls resulted in a slower same-store sales growth during the quarter. The softness was largely industry-wide in nature. The company continued to prioritize full price sales ratio by maintaining a full price sales ratio more than 95%. This disciplined approach helped us maintain healthy gross margins at a stable 64.3% in Q3 FY26, which further highlights the strength of our pricing of our brand. Q3 FY26 was deeply impacted by a slowdown in our LFS channel. One of our key LFS partners had a pause of fresh inventory intake across brands, which affected our LFS sale by 30%. We continue to engage closely with our LFS partners and expect this channel to normalize as we continue to supply inventory to them. We continue to engage with our LFS partners to ensure that these kind of interim issues what we have faced, we don't face again. To drive improved same-store sales growth, the company has undertaken focused initiatives around customer engagement and new product launches. In parallel, we had recently collaborated with a leading influencer to showcase our bottom wear collection and enhancing the brand visibility and relevance among younger audience. Such initiatives are expected to support stronger customer traction and improve store-level performance over the coming quarters. Over the time, we have strengthened our position in the non-leggings category, and it has further strengthened. Today, a non-leggings bottom wear category gives us a 65% contribution in our sales, which in earlier times used to be less than 50%. Moving over to the operational metrics of Q3 FY26, our store expansion strategy continues to remain calibrated and selective with a clear focus on entering high potential markets. As of 9 months of FY26, the company has added 49 stores and we expect to close FY26 with a net addition of 60 to 70 stores. Our approach to network expansion remains very disciplined with emphasis on store-level profitability and strengthening brand salience. We continue to keep a close watch on inventory levels, with inventory levels being at 114 days as of December 31st, 2025. On the inventory front, we have seen an increase in our inventory because for our new concept, daily wear concept, which has increased our inventory marginally from the earlier times. For the full year FY26, we anticipate inventory levels to stabilize at the rate of 100 days, ensuring operational efficiency and healthy working capital management. Our strong focus on inventory and working capital efficiency will help us achieve the target of converting more than 50% of our EBITDA into pre-Ind AS operating cash flows. On our new initiatives, including our international store in Dubai, Our daily wear concept are demonstrating healthy unit economics in early stages, and we remain excited about their performance in the coming quarters. As of now, we have opened 6 stores for our daily wear concept, and we look to make it about 10 stores by March 2026. In line of our commitment to shareholders, we've announced a buyback this quarter of 14,13,000 shares at a price of 460 rupees per share, with a total size of rupees 65 crores. Way forward, smaller format stores, the small size stores, has been witnessing a sharp decline in performance because today's consumer is looking to shop within a larger store experience. So in line with that, we had consolidated some of our smaller stores last year, and we will look to continue some of our remaining smaller stores in the quarters to come. The company is taking a cautious approach on new store expansion with a clear focus on strengthening same-store sales growth. Our priority is to improve performance across the existing store network through better execution, enhanced customer experience, and operational efficiencies. Our immediate objective is to move from negative same-store sales growth to flattish and then eventually taking it to low single digits, supported by improvements in store level productivity and throughput. This will not only be driven by external factors, but even by sharper execution at a store level, introducing new products and better engagement with our new audience. Second, our footprint expansion will be driven by careful selection of high quality locations through picking and choosing the right location with strong unit economics. Lastly, recognizing retail is fundamentally a balance sheet business, we remain sharply focused on cash conversion, higher inventory turnover, and disciplined capital allocation, ensuring business remains profitable and is a very ROCE-centric business. With this, I would like to hand over the call to Mr. R. Mohan for an update for Q3 and 9 months FY2026 results and financials. Thank you.
Thank you, Gautam, and good evening, everyone. First, I'll give the Q3 financial numbers. Our revenue for the quarter stood at rupees 195 crores. Gross profit stood at rupees 125 crores with a gross GP margins of 64.3%. Our EBITDA for the quarter stood at rupees 52 crores. EBITDA margins is at 26.7%. PAT for the quarter stood at 7 crores. PAT margin is at 3.1%. Coming to the 9 months FY2026 performance, revenue is at 642 crores. Gross profit stood at 406 crores. GP margin at 63.2%. EBITDA is at 187 crores with EBITDA margin at 29.2%. PAT stood at 51 crores with a PAT margin of 8%. ROCE and ROE excluding Ind AS impact as on 9 months FY2026 stood at 13.1% and 10.3% respectively. Cash and cash equivalents stood at 256 crores as on 31st December 2023. With this, now we will open the floor for the question and answers.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touch-tone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. The first question is from the line of Devanshu Bansal from MK Global. Please go ahead.
Yes, hi Gautam. Thanks for taking my questions. Firstly, I also wanted to understand how should we read your SSG performance. We were flat for a fairly long period of time, but now reporting in the negative trajectory for last 3 quarters. Though you mentioned that from a retail parameter perspective, footfall is the only challenge. But my concern was that even footfall, we are attributing it to weak consumption, but is there a certain level of deterioration of brand strength so that it is not attracting the relevant or amount of footfall? So your color on this will be very helpful.
Yeah, thanks, Devanshu. No, I think, Devanshu, from a brand perspective, I don't see that. Yes, we want to, as a brand, increase our younger audience as a customer base. But from a brand strength and relevance perspective, I think we are very much there. See, even from a product mix perspective, if you see today, 65% of our sales are coming from the other value-added products, and that's how the market, the bottom wear market is heading in direction. So I think from a brand relevance and product relevance perspective, I don't think is an issue. I think the overall footfalls in Q3 has been very weak. See, we've done many channel checks also, and we have seen similar kind of trajectory in other places as well. So the overall macro scenario obviously has had to do a lot. The footfalls issue has had to do a lot with our SSSG. Other thing which I mentioned in my speech, our SSSG in a very small store. See, today what has happened, because the bottom wear market has become a wider market with so many products, the very small stores from an experience perspective becomes a little bit of an issue. And we have seen softer and larger degrowth in SSG in those very small stores. So I think the larger attribute to a negative SSG is obviously the overall macro scenario and footfall, and these small stores which have degrown a lot more than normal because of the size.
Fair enough, Gautam. But this footfall issue, is it also related to consumers sort of preferring to shop more online or via quick commerce channels, where our presence is very limited, right? So are you also thinking on ramping up our presence in these channels because footfalls, etc., may remain weak, right? So if the consumer preference is shifting towards other channels, or maybe through formats where they are getting the entire wardrobe rather than preferring to go for a standalone bottom wear store. So how are we sort of focusing on capturing such consumption occasions?
Yeah, see, in fact, I mean, rightly you said, Devanshu, I think, look, online and quick commerce has always done well. And for us, because we are having a very small contribution, so that's a channel for us to build. So our online channel has seen decent traction. Our quick commerce also, we have been live on Blinkit and Zepto, and we've seen very good traction there. So I think as that channel picks up speed for the apparel category, our share also in the e-com space will organically grow. So from an e-com and quick commerce perspective, we are there present with our styles and inventory across all channels. I think it's just a matter of time. Once it picks up speed, it will also start reflecting in our revenue numbers.
Fair enough, fair enough. And lastly, Gautam, few clarifications from the LFS side. Our revenue mix has improved towards EBO, right? So it is 80% EBO this time around versus 74% last year. The gross margin for this channel is about, in my understanding, 35-40% better versus the LFS channel, right? But if we see from a company-wide perspective, this should have reflected in 250-300 bits better gross margin on a YOY basis. But this is flat, right, in this quarter. So is this largely due to deterioration in gross margin profiles of LFS channel as well? So what explains that? So, yeah.
Yeah, see, we are also studying that, Devanshu, and I will come back to you on that. But at the outset, when we are looking at it right now, last year we had started EOSs a little late at the EBO level. This time we had started a little earlier where usually we start. Last year our EOS start date itself was late. So because the quarter 3 had a week, 10 days of more EOSs week, that could have had an impact on the EBO gross margin, which is not reflecting in the upside of the overall company gross margin because of low LFS. We are anyway studying this. We'll come back to you with more clarity around it. But at the outset, it looks because of the start of early EOSs, which is by a week, 10 days.
Okay. And from a model perspective, is your LFS SOR based, or then the partners can return the inventory in case they are closing the store, or how is it?
So usually it is like this, Devanshu, it is based on SOR. So what we do as per India's standard is because it's on SOR, we show it as debtors in our books. We show it as sales when we dispatch the goods. So it is debtors in our books, but because it is SOR, as per India's 115, we have put a provision for sales return based on historical trends. So whatever is the last 3 years of historical trends of return, we provide it on a quarterly basis. So the provision of sales return is inbuilt for any stock which is coming back through the year.
No, that's fair. But what happens in terms of store closures, right? So we have had
For example, yes, your question is right. Suppose today an LFS decides to shut 20 stores. Those 20 stores stock will come return and it will be booked as a sale return. But what happens, such increase in return will reflect in the next year's provisioning, because you tend to usually take a 3-year average of for a provision of sales return perspective. But to your question, if an LFS shuts 30, 40 stores or whatever stores, the stock coming back will be shown as a sales return.
Fair enough. Thanks for taking my question. Sorry.
Thank you.
Thank you, Devanshu.
Participants who wish to ask a question, you may press star and 1 at this time. The next question is from the line of Gaurav Jogani from JM Financial. Please go ahead.
Hi. Thank you for taking my question. My first question is again with regards to the LFS channel only. This quarter we have seen 137 odd LFS getting shut QOQ. So one, what is, was there anything specific this quarter that we saw such large closures? And how do we look for expansion in LFS going ahead?
Yeah. So see, Gaurav, these stores are largely one of our key LFS partners. They have changed the format of that store and they have changed it. They've rebranded and changed the format of the store. So when that happened, all the external brands had to move out of those particular stores, including us. So the reason we have exited the stores because the key partner had decided to change the format and rebrand it. Now moving forward, LFS expansion from a store addition perspective, whenever we do get an opportunity for adding new stores, we will selectively choose which location makes sense and then we will select. Like in Pantaloons, we have been expanding and adding stores over the last few quarters. Even in Reliance, we are getting new stores. So selectively on the basis of what is being proposed to us, we will select those locations and move forward. As far as quarter 3 is concerned, our quarter 3 revenues were deeply impacted because for one of our key LFS partners, we were not able to dispatch stock for about close to 45 days. They were not taking inventory across brands for a period of 45 days, and because of that, we were not able to dispatch stock. And that is why we've lost 45 days of dispatches, which has resulted in 30% drop in sales. And that's why our Q3 numbers, overall numbers have got deeply impacted because of this dispatch issue which happened in November and a little bit of December as well.
So Gautam, can we expect this to, come back in Q4 in some time?
Not really, because what happens, that 1.5 months which we have lost, what happens, how do we replenish stock at an LFS store, right? We keep a base stock. We decide a maximum stock level. Now, based on the maximum stock level and the closing stock at an LFS store, you're basically only sending the difference. So in January or February, it's not that you're going to be sending additional stock. You're going to be sending stock only to the extent of the maximum stock level. So the 45 days what we have missed out, that increase in number will not see in January and February.
But if that 45 days we had missed out, they would have, again sold.
Yeah, I understand. But ours is a replenishment business. So sales will happen, you keep replenishing, your sales will happen, you keep replenishing that store, right? But your maximum base stock is only to a certain level. So if you have not replenished 45 days, you have to a large extent lost out on a lot of secondary sales. Now, we will not be able to recover those secondary sales in the coming months. So technically, you're sending only that much stock which is there in the base stock.
And Gautam, just completing on that LFS opening part, so how many LFS now we can model into open, at least for Q4 and the rest of the couple of years going ahead?
See, it's difficult to say. It's difficult to give a guidance on how many LFS stores we will be opening next year. It all depends on how our partners expand. And in that proposal of expansion, what we think would be relevant. So it's going to be very subjective to what is being proposed to us. See, sometimes a partner can decide to add 70 stores, 80 stores, but certain key markets, you wouldn't want to be part of that market. So it's very subjective to what is being proposed to us. So I think that we will be able to only know next year as we are proposed with the list of stores.
And Gautam, coming back to the EBOs, are you seeing any recovery in the momentum of any sorts in the a month past by January to indicate, that from a negative 4.5% SSSG that you're looking at in Q3, probably you will go flattish on that thought, or it continues to remain weak as it was?
See, Gaurav, see, we are seeing two trends, Gaurav. I think what is happening is our mid-size stores, stores which are slightly higher than 500 square feet, 600 square feet, see, because our product range has increased, right? 65% of our sales are coming from the non-leggings category, the value-added categories. So today, the consumer wants display and experience of shopping when you're seeing so many products. So we are seeing two trends, right? The smaller stores, the very small stores are obviously seeing a decline because we are not able to display all the new products. The slightly larger stores, which are the 600, 700 square feet stores, they're seeing good increase. Some of the stores are actually showing very good positive SSG as well. So I think over a period of time, as our small stores phase out of the system and the newer stores, what we cautiously add becomes of a relevant size, you will also see improvement in SSG from that perspective. But largely the improvement of SSG is going to be obviously relating footfalls. So I think both these things hand in hand will play a very important role in the recovery of the SSG from being negative to a mid-single digit of positive.
But Gautam, in this scenario, the expectation, then there could be a possible drag on the margins because your cost will keep on escalating at a certain pace. So would it be fair to assume that, at least over the next 3-4 quarters, you might see a decline in the EBITDA margins just because of the negative leverage?
See, I'll tell you what we are planning to do as a company, right? Right now, we are being very careful with expansion. So right now, we are prioritized and thinking how do we get the SSG back to positive. Today, we are at -5%. Our aim is to get to mid-single digits to 5%, right? So from -5, we have to take it to +5. So all our efforts right now as a company is to see how we can fix this and get this into positive. Of course, the overall footfalls is going to make a very big contribution to this. But we are also going to be putting in smaller efforts at new products, opening better looking stores to fuel that. So our first priority over the next 1 year is to definitely put entire focus on improving SSSG and maintaining margins. So on the expansion front, we are going to be very selective in our expansion in the coming quarters. So that because of expansion, there should not be a EBITDA hit in the P&L. Because what happens, Gaurav, when we are in new stores, immature stores which are not mature, they are a load on the P&L because you are paying the full rent and salary without the store being mature. So we are taking one step back and saying, look, hey, we will be very careful in our expansion, not go overboard with the expansion so that margins don't get compromised during this recovery period.
So then can we expect the store opening to even come down next year in the EBO format versus the 60-70 that we're expecting this year?
See, honestly, Gaurav, we are not guiding, we are not giving, unlike like earlier times, right? Earlier times we used to be very clear with our guidance on how many store openings. This time we have seen that our margins because of because of negative SSGs, margins have taken a hit. So and as a management, we have taken a conscious call to slow down the store expansion and do it selectively. See, that does not mean that we will not expand. See, wherever we are getting a very good opportunity and where we should feel that we should be there, we will also expand. But we are not setting ourselves a target. During this recovery period of taking SSSG from -5% to +5%, we don't want to compromise on the health of the P&L.
Got it, Gautam. Thank you, and that's okay.
Thank you. The next question is from the line of Ankit Kedia from Phillip Capital. Please go ahead.
Gautam, just continuing from the previous question, is it fair to assume next year's store opening could be around, sub 50 stores or even lower than that? Because this year with 60, 70 stores also your margins have been hit, and next year also the recovery is question mark. So definitely the store opening would be below 50?
So Ankit, I know where you're coming from, and honestly, it's very difficult for me to give a guidance right now. It all depends when does the SSG pick up speed, right? And suppose if things go well and next year I'm just giving you a hypothetical example, by next year middle or maybe the second quarter, we come back to positive SSSG, then maybe we also start increasing our footprint as well. So it all depends on the recovery of the SSSG. So it's very difficult to give a number for next year, whether it will be below 50 or above 50. It's very difficult to predict. But as management, we feel that we will not go to an extreme of not opening also. Like, for example, if we get a good mall which is coming up in a Mumbai or a Bangalore or any other city where it's a prospective mall or very prospective high street, we will definitely go and open there. But we will not go overboard and try to open everywhere also at the same time. So we keep a good blend.
So given that it takes 3 months to 6 months to open a store, and today with you at minus 5-6% like-for-like growth, next 6 months store opening will be muted. At least that we can assume?
Yes, it will be muted. So it's difficult to give a number, but I can tell you it will be muted for sure because we are going to be very cautious in our approach.
Sure. Second is on the
sorry, Ankit. But just extending to the thing, we'll also be doing a lot of relocations, Ankit. So what will happen sometimes, like I explained to you guys, we have sometimes very small stores which are not doing well. Today the consumer wants a slightly better experience. So in the same market, we might shut the older store and open a new store. So there might be some relocations which will have a positive impact on the revenue number as well.
Gautam, we would appreciate if you can share the area of the stores today. At a 800-900 store network, we don't know what is the area. Given that bulk of the store closures of smaller stores are behind us, and now you're opening 600.
So what I do know, Ankit, in the next, probably after this earnings call, once we have calibrated the entire data, we will share the data with everyone, how many stores are there, which are the smaller stores, so everyone has clarity on that.
And how many more store closures are remaining for the smaller stores? And can you just share the decline you are seeing in the smaller stores?
Yeah, we will share. First, we are calibrating the data. So once we have calibrated the data, we will be happy to share.
Okay. No, because on the previous question, you said that the smaller stores are significantly negative SSSG are declining. So at least some data you would have to pass that comment, right?
We've seen, I'll tell you, like for example, where our company average level is minus 5%, the smaller stores we have seen a slightly higher degrowth of more than 9-10% SSSG. And sometimes numbers are not fully reflected. Even when we are visiting stores and when we are interacting with the consumer feels that, okay, in a slightly larger store of a 500, 600 square feet, the newer bottles, the newer styles are better on display. So it becomes easier to shop. In a very compact store of 200 square feet, it becomes very difficult to display all the items to the consumer. So from an experience perspective also it hampers.
So I agree, because your core moat was a smaller store, high throughput, high margin business. Now that is getting disrupted because your average store size is becoming 600, actually incremental store size.
Ankit, the unit economics of a 600 square feet store and a 300 square feet store is not different. Even a 600 square feet store from a unit economic perspective comes under the same category as well. So it's not that my EBO unit economics will go down because I'm opening a 500, 600 square feet store. See, if today I would have gone and opened, say, 2,000, 3,000 square feet store, that's a completely different unit economics. But stores which are sub 1,000 square feet have similar unit economics for a 200 square feet also and for a 550, 600 also.
Gautam, at least last 3 years since we started opening bigger stores, sales per square feet has declined. If you see. Now that could be due to market environment, or it could be due to loss of market share, or could be due to loss of footfalls. It could be either of it. But at least on the face of it, we have seen a decline in sales per square feet.
So your question is right, Ankit. So the sales per square feet would be more because of the footfalls in the overall macro scenario. It is not because we have gone into a larger store and the unit economics are not as good as a smaller store. It's not because of that.
Sure. My second question is on the LFS. You made a comment that one of the large retailers is switching the stores which had third-party brands to private label brand. Now, do we have visibility that next year that won't happen from the retailer, or it's going to continue and we have been said that few hundred more stores could be closed in the medium term?
See, we are also trying to get that clarity, Ankit. But honestly, if you ask me the truth, I don't know. Can it happen next year? Maybe yes. So we are also speaking to our partner and trying to get that clarity so that we are also prepared on if there are going to be such, format changes at their end, we will know about it. So we are trying to find out the minute, I have some clarity on that. Maybe in the next earnings call or maybe in between that, I'll definitely guide everyone on that.
Sure. And, on the inventory part, right?
Yeah.
Our gross margins have expanded, but, with the change in format and other things, how are the commodity prices placed today? And, with the GST, pricing being more favorable, at least for higher price points, about 1,000 rupee products, going forward, do you feel the need to reduce the discounting which you are giving to the consumer, or the new labels have come up? How will that pricing change, and how are the commodity prices?
Honestly, Ankit, you're talking about the GST reduction, right? Those products you're talking about, right?
Yes.
Yeah. So we were giving the benefit to the consumer. We have not changed our MRP for such products. So we are continuing to give the benefit to the consumer. There might be a time where we feel instead of taking a price hike for those products, we just remove the discount what we were giving for the GST benefit. So in short, we have not taken the price hike, but we get the benefit of that eventually. But when we are going to start doing it, we are deciding it internally once. So to answer your question, we are not changing the MRP of those products where the GST was reduced. Wherever the GST was reduced, we were passing on to the consumer. Eventually, instead of taking a price hike of those products which were due, we would just remove that benefit without taking a price hike.
And in the other products, sub 1,000 rupees where the discount was not available, 5% remains 5%. There, are you considering taking a price increase?
No, not right. See, Ankit, we are in a volume-led business, right? So our entire company's focus is to drive volume. I have reviewed the products under 1,000. We have made very small corrections in certain products where we have increased the pricing because it was underpriced to begin with. But those are very, very few products. Largely, we have not touched anything under 1,000 because we feel we are well priced.
Last question is on the A&P spend. Do you think at this point of time you need to be aggressive in A&P? Because previously you always said when demand is not there, you don't want to spend because if this demand is not there, consumers are not going to walk in. But has that, mind shifted that you have to go aggressive at this point of time?
I think no, I don't think we have to spend more, honestly. So I think that logic of 2% of revenue still holds good. This time it shows a little more because our revenues this year have stayed flat, but we had marketing budgets allocated for a growth revenue, right? So that's why as a percentage of revenue so slightly shows higher. But from how much we want to spend, I don't think that number will increase. We are just transitioning our digital marketing to a very different methodology where we are reaching out to the younger audience and the millennial audience by different type of personalized marketing. See, our marketing team to begin with was a very old school, orthodox type of marketing. It's now changed over a period where we started pivoting towards more and more digital. So I think the way of marketing is going to evolve. But from a spend perspective, I don't see our spend increasing. We used to spend 2.5% or 2 to 2.2%. We are going to be around that number. So as a quantum of spend, it's not going to increase.
Sure. And can I ask another question since I've taken a lot of time?
Please.
Just on the top, if it's not topware, given that bottomware is under pressure, which is the core bread and butter, do you think it's prudent now for you to continue to expand topware, aggressively, or concentrate more on bottomware?
No. See, I'll tell you. The topware project, what we have done, the everyday concept, that's just a pilot. And I cannot see the pilot needs its time, right? So now we've opened 6 stores. So that will take its own journey. And that decision making in that pilot is independent of bottomware. So we are not going to speed up that in any way to show growth. So that pilot will go in its full speed. It's going to take some time and it's for the future. As far as bottomware is concerned, we are very, very bullish on the category. Yes, This has been a very tough time for the category and the brand that we see headwinds and it's not reflecting in numbers. But our conviction in bottom wear is very much there. Even our recent Technopath study also emphasizes that how large that category is. So even from a short-term, mid-term and long-term perspective, our entire energy and strategy for bottom wear is very much intact.
Sure, Gautam. Thank you.
Over the next couple of years, Ankit, if we have to show growth and the numbers have to come, it has to come from bottom wear. We cannot expect the pilot to take care of the gap of growth. The pilot is there and it will take the pilot in its own sweet time. We cannot rush the pilot. Otherwise, we won't do justice to that project as well. Bottom wear is our main business and we'll fix it and we'll bring it to growth. We are very bullish.
Noted. Thank you, Gautam.
Yeah.
Thank you. Ladies and gentlemen, in order to ensure that the management is able to address questions from all participants in the conference, please limit your question to 2 per participant. The next question is from the line of Vaishnavi Mandania from Anand Rathi. Please go ahead.
Hi, thank you for taking my question. I just wanted to understand that how much of this SSSG decline can be attributed to the entire store size issue that we faced, because you said that the smaller stores saw a relatively negative SSSG, or rather the larger stores saw better SSSG performance versus the footfall in general being weaker.
See, I would definitely it's very difficult to quantify it. I would say this SSG is negative because of the slowness in footfall and the overall weak environment. It's very difficult to quantify, but I would put it more towards the overall macro scenario.
So what I'm trying to get to is that, let's say in H2, right, where we, I think, almost shut almost 40 to 50, H2 FY25, we shut, I think, almost 40 to 50 of the smaller store formats. We said that the store closures are almost done, but again, now in this quarter, we're coming up and we're saying that we're still seeing the performance of the smaller stores not being up to the mark, which is why we're shutting them again. So I'm just trying to understand, where are we coming in this entire small store, large store, medium store, and how should we look at this in terms of our performance as well?
See, the stores what we shut last year, yes, we did shut those stores, and we have seen that when we shut those smaller stores, the revenue moved to the nearby larger stores. So we saw that. It didn't have a very big impact on SSSG because 40 stores as a base on such a large number of stores will not move the SSSG needle so much. Now, as far as how many stores we are going to be shutting, we are calibrating the data of the smaller stores because we can't just shut those stores just like that. We'll have to also see when are the lease renewals coming up. So as we get more clarity on that, we'll definitely guide the market on how many such stores in the smaller bucket is there and how many of the smaller stores will be shutting in the short term. We will also guide that once we have calibrated the entire data. So as from your end, you will also have clarity on what's happening.
All right. And one more thing, if we can also get some more inputs in terms of how does the unit economics, etc., move for the slightly larger stores, like what the earlier participant was also suggesting. Because when...
Very similar, Vaishnav, and I'll tell you why. See, you understand, I'll tell you why a 500, 600 is very similar to a 200, 300, and I'll tell you why. When we sign a store, we sign on a rent-to-revenue ratio. So if the rent-to-revenue ratio is in our budget, whether it's a 600 square feet store or whether it's a 200 square feet store, your EBITDA prior to staff expenses will be the same. Now coming to staff expenses, because that is the real difference between a 600 square feet store and a 200 square feet store. In a 600 and a 200, the number of people you employ for managing the store are the same. Your operating expenses also are pretty much the same. So a 600 square feet store from a unit economics delivers the same unit economics what a 200 will deliver. The difference always what happens is when you go past 1,000 square feet, suppose you open up 1,500 square feet, the unit economics dramatically changes because the electricity cost dramatically goes up, the number of people you're going to be keeping in the store dramatically goes up, then you'll have to keep separate housekeeping staff. The entire mathematics on employee cost dramatically changes when it crosses to 1,200 square feet, 1,300 square feet. Sub 1,000 square feet, you're keeping the same number of people what you're keeping in a 200, 300 square feet. So the difference is really those other operating expenses in which the staff cost is the highest.
Okay, understood. Also, one last question. In terms of the newer stores that we're opening, which are slightly larger in the size, are they again in the nearby vicinity of the smaller stores, or are we targeting different clusters or in the same
No,
cluster?
no.
What
See,
is
we
the
are
strategy there?
one more thing is, definitely during these times where SSG is off, we are ensuring that we are not giving any room for cannibalization. So now when we are opening stores, we are very careful that we are trying to open in different clusters where even the smallest remote chance of cannibalization should not happen. And that is why we are extremely selective and cautious in our approach of store opening.
Okay. All right. Thank you.
Thank you. Ladies and gentlemen, you are requested to restrict your question to two per participant. The next question is from the line of Prerna Junjunwala from Elara Securities. Please go ahead.
Thank you for the opportunity. I just wanted to understand your revenue mix also this quarter. You have given bifurcation wherein from non-legging sales is around 65%.
Correct.
As a category, that category is not seeing that kind of difficult times in our opinion. So I wanted to understand which category is seeing slowdown, or is it an overall all categories are seeing decline at the same time, or what is how product is changing?
I'll tell you. So Prerna, I'll tell you, see, the product mix change has very little to do with the negative SSSG, and I'll tell you why. When pre-COVID, when we had SSSG of more than 15% or we were double-digit SSSG, even that time the product mix was evolving and changing. See, product mix is something which evolves even when your SSG is positive or negative. So that has nothing to do with that. The real reflection of SSG being negative is more to do with the footfalls. The main reason is that it is not because this product has gone down and this product has slightly improved that it is reflecting a negative SSSG. The main reason of SSSG decline is because of the decline in footfalls. So suppose if you are having -5% SSSG today, our footfalls are down by -5%. So what directly correlates with negative SSSG is the footfalls and not the product mix. Because what we've seen in the past, even in the good times when we had double-digit SSSG during pre-COVID, our leggings churidar contribution was falling at that point of time and our other product sales was improving. That was something which we had envisioned that was anyways going to happen. That legging as a category is going to continue to decline even in the future.
Okay. Understood. And but then I'm just trying to understand because other apparel players have not been declining every quarter the way you have been declining. So and footfall in this quarter, especially given that the season has been decent and the footfalls have not been a complaint by many other categories and especially segment as well. So
Okay.
why would footfall be a problem for you for more than 3 quarters now?
See, difficult to answer this question, Prerna, but see, in quarter three, of course, our numbers are weak, right? So the first thing what we do is we do some channel checks. So we have seen a decline everywhere, but the women's category, we've seen a bigger decline. And this I'm saying about in general, overall women's apparel. Irrespective of top wear, irrespective of bottom wear, irrespective of whether it's ethnic, western or fusion, whatever little bit channel checks as a company we've done, we have seen slowness everywhere.
Also, is there any strategy change with respect to ownership of stores because all your stores are on your book and any franchisee options that you are evaluating so that salary employees can be better?
See, the COCO model works very well for us, Prerna, and it gives us better control from a hygiene perspective also. We've realized that COCO stores deliver a much better customer experience because we have SOPs in place. So for us, we are largely going to go to the COCO route. Franchisee route, we are not against, but we will do franchisees very selectively in markets where we are not having operational control, very similar to what I have narrated earlier. From a ROCE perspective, see, as the business improves, once growth comes back onto the table, the margins improve, automatically the ROCE will start showing a better figure than what it is currently. But from a strategy of COCO versus FOFO, I feel we are going to continue with the COCO because that's a model that works for us. Because sometimes we feel from a cocoa perspective, the store experience, the store look, everything, look and feel, everything will be well maintained in the cocoa model.
Understood. Thank you and all the best.
Thank you.
Thank you.
Thank you very much.
Ladies and gentlemen, in order to ensure that the management is able to answer all the questions from the participants, please limit your question to 2 per participant. The next question is from the line of Resham Mehta from GreenEdge Wealth. Please go ahead.
Yeah, thank you for the opportunity. So, the first question is basically on the market share data. As per the latest Technopack report, can you call out what's your market share?
Yeah. So, the report says that we are having the same 8% market share in FY24 what we had earlier. And it shows that the branded market for bottom-wear is about, it's a 10,000 crore branded bottom-wear market as on 2024, in which we have a 8% market share.
Okay. And can you just call out the initiatives taken, to drive footfalls as far as customer engagement goes?
See, I think driving footfalls to a very large extent is determined on the consumer sentiment. So that's not very much in our hands. So what best we can do from our end is to ensure that our product mix is good, our stores are well located, and our marketing, our digital marketing is strong. These type of levers are in our control, but the overall consumer sentiment which is there in the market is something which we'll have to wait and watch how that improves. These initiatives of just ensuring that we have the right product mix and we're doing right digital marketing is what we can do at our end to ensure that we deliver best SSG.
So when you say customer engagement, what you are essentially referring to is the digital marketing.
Yeah, I think we started a lot of personalized digital marketing works very well. See, today, a lot of our digital marketing has moved to personalized customer where today a consumer who's shopping in a Go Colors who's buying certain categories, we promote the other categories through WhatsApp, through Instagram. So our entire digital marketing has become more personalized around the product with our existing customers and new customers. So we are leading our digital marketing is more transitioning into product-led communication than just brand communication. Like for example, if you're a user, you're a customer of Go Colors, you've been buying X number of products, but you don't know that this product is available at a Go Colors. Through our data, we will know that X person is buying this. So what we've seen in recent past, when we are personalizing advertising communication for that person is able to see, okay, this product is also available. So you're able to get that customer back to the store. So we are just creating our digital is moving more personalized product lead, which works for us very well. So we do it direct and we also do it through influencer.
Understood. And, you've made these product changes, right?
Sorry to
product
interrupt you,
launches.
Resham.
Madam, please let her continue.
Oh, okay.
Madam, please let her continue. No problem. Yeah, please go ahead, Resham.
Yeah. So, and with all these new product launches, which we can see out there in the stores, right? Would you say, you've spoken that, okay, brand dilution is not an issue, other issues are not there, but do you see that somewhere, the value proposition for the customer has, become a little bit weaker? Because if I see, as we have westernized our portfolio, right? Western wear is, somewhere where there is a lot of competition. So if I just compare, the merchandise for the new product launches that we have done with, let's say, an offline store like a West Side, or even if we go lower, on the value side, Zudio, etc. At least, West Side probably, would have similar merchandise, but at a much lower price point, right? So then, your customer is probably, we're not seeing footfalls, not because of other reasons, but just because, the value proposition has weakened with us.
I understand your question. In fact, I'll tell you, this is something which we covered in the Technopack. So in fact, we added this in our presentation recently. So we put a triangle chart in that updated slide on market size and our share. In that, what the study says is that more than 500 to 1000 and 1000 and above contributes to more than 2/3 or maybe more than 70% of the bottom wear market. The less than 500 category is a very small category compared to the mid-premium and the premium category. See, the bottom wear category, when you take the value-added products like trousers, palazzos, it's very difficult to price it sub 500. The sub 500, to what I have studied, is a very leggings-oriented market.
No,
So
sorry.
even in that
Sorry to interrupt. I'm
Yeah.
not referring to the sub 500 market. Okay, so now let me be very specific. For example, the
Sure.
wider bottom denims, right, which have been launched, right? So now, for example, our MRP is, let's say, a 1300, but if I see
Correct.
similar merchandise in, let's say, a website, it's priced at 1000, right? Then, clearly, I mean, this is just one example that I'm giving you, right? So then clearly, the value proposition for the customer becomes far superior, with our...
Oh, you're saying from a competitive pricing, you're saying?
Yes, yes. And this is just, I'm
Okay.
talking about, let's say offline competition, right? And if we move to online, it's a much wider world out there, right? With plethora of options there, right? So then with that, do you think, let me put it this differently, that if, let's say, if you were to drop your prices, okay, on some of your specific merchandise, right, like by X%, do you think that is going to boost footfalls, or do you think that is not the case?
Okay. So I understand your question, Ishman, and I'll clarify this. See, what we try doing is when we launch a product, we try benchmarking it at what prices will a like-to-like product or a similar product be selling in the market. So maybe this one product which you're mentioning, maybe we have overpriced it by 200 rupees. Maybe that's a one product phenomenon. I'm not going into the specifics of that product. In general, when we are releasing products, we benchmark to see that we are not very expensive compared to competition. We should be either on par or maybe lesser, and that's how our pricing strategy is. So we don't want to put ourselves in a situation where we've launched a product at a premium, realize that it is very expensive to competitors, like other competitors, what you mentioned, and then we drop the prices. So to begin with, we are ensuring that we are not pricing ourselves so much higher than what is available in the market. So I'll give you another example what happened in our new concept, what we opened, the new daily wear concept. So certain products of menswear, what we launched in the Linking Road store and the other 5 stores as well, we had priced it a little higher. When we realized that we had priced it a little higher than what is available in the market, we immediately changed the pricing. Because that's a new category and segment for us, so we are also learning. In bottom wear, because we have done it over so many years, when we are releasing a product, we keep studying what our pricing is and versus what is there available in the outside. Maybe an exact product is not available, but at least a like-to-like or similar product, what price it is selling. So we try keeping that price parity to begin with. Sometimes we make mistakes like that one product maybe you mentioned we did go wrong. I don't want to be specific about that product, but in general, it's a conscious effort that we get our pricing right from day one.
Right. So you don't believe that, if we bring our prices down, we are going to be seeing more footfalls, right?
Not at all. Not at all. To begin with, we are pricing our product very sharply. And it's in line with, if the product is available out there, it's in line with that.
Right. Yes, and
I'll give you a basic example, right? Let's take our legging product. So you'll have leggings of different price ranges. For a product of our spec, I'm taking legging because, right, that contributes to 35% of the business. I'm taking that product as an example. If you take a product of similar spec, you will see brands selling between 549 and 649. So we are somewhere in between. We are at 599. So we are very mindful of that, see how we price ourselves. We want always ensure that, okay, we are giving good comfort and quality, but the pricing should be sharp.
Right. And I do acknowledge, the fresh merchandise and, the new product launches, they're very much visible in your stores, in Mumbai at least, right? So I do acknowledge that, right? And I have one more question if I can squeeze in.
Sure. Please go ahead. Please go ahead.
Thank you. That's the last one. So, a lot was spoken about the store sizes, right? So typically we've been in that 300 to 600 square feet kind of store size. Now the new stores that, whatever calibrated muted store count that, we would be opening, they are all at 1,000 plus. And also a related question that when you say small stores, I mean, do we have definitions of small, medium, large stores internally?
So the new stores what we are opening for the bottom wear stores, I'm not talking about the pilot. So for the new stores what we are opening for the bottom wear will be below 1,000 largely. So it will be in that range between 500 and 1,000. It will be mostly in that range, but we are unlikely to cross 1,000 unless it's a very good rental deal we're getting. But we are largely going to be in that bracket of less than 1,000. When I talk about a small store, yes, any store which is effectively lower than a 300 or 350 square feet store comes down to being a small store. So it also depends on the depth and the width of the store, but without being too technical, anything below 350 and 300 is regarded as a small store. Where today we are not able to display those products in a very small store.
Sure. We'll look forward to, more granular data on the store sizes in your next presentation. Thank you so much and all the best.
Thank you. Thank you.
Thank you. The next question is from the line of Sameer Gupta from IIFL Capital. Please go ahead.
Hi, good evening everyone. Thanks for taking my question. Gautam, firstly on the LFS channel, now even if we exclude the anomaly of this quarter, the growth or the performance in this channel has always been volatile. Some quarters it is up more than 20-30%, some quarters it is a decline. So if this is a replenishment model, which you alluded to an earlier participant's question, technically growth should be smoother, like, the way we witness in our EBOs, because that will be the capturing the end level consumer. And just to follow up on this one again, so the LFS key partner that you're talking about changes formats, not buys for 45 days, and they don't really inform us beforehand so that you can plan better?
Well, so I'll answer your second question. Yes, we were obviously not informed once festive got over. POs were on hold. We couldn't sell stock. It was something which came up we didn't know about it. We obviously couldn't foresee it. As far as format changes also concerned, I think format changes is very common, not for this one LFS partner. It happens anywhere. Brands are always informed only at a particular point of time. They will never be informed in advance, but that's how retail works. But on the PO part, definitely we should have been informed that this was coming, but we weren't. Luckily, we were able to solve those things post December 15th, and as of now, things are running smoothly. And we are also trying to work with that LFS partner to ensure that such operational issues don't happen in the future. On the volatility part, Sameer, I think, there are two things, right? Where can we have volatility in LFS? One, if there is a fall in secondary sales because of footfalls, or B, we have not replenished the store properly. I think the volatility in Q3, what we have seen was a point that we were not able to get the purchase order and we were not able to replenish. I think the volatility depends on which aspect, whether it is secondary related or whether it is primary related. So this quarter we have seen that it was more around the perspective of that we were not able to dispatch. And that's why we saw a fall in revenue in LFS. In previous quarters, there were some quarters where the secondary sales itself were low and we could only replenish based on what is sold. So I think that was a very different reason altogether. This issue what happened in Q3 is more of a very direct operational issue rather than I would say a consumer sentiment or market issue.
Got it. But the previous quarters are more reflective of the consumer.
Yeah, that's what I'm saying. It's not an apples to apples comparison, but yeah, I mean, at the outset it looks okay, LFS has degrown. I think the underlying reasons in what was maybe in the earlier quarters and what is today are different.
Fair point. Second question, again, it's a follow-up on an earlier participant's question. So brand relevance and strength. Now, it's been 11 quarters of flattish same-store sales, and you're confident that this brand strength is still very, very relevant and strong, and you alluded to the brand market share is intact at 8%. So the last 3 years, then only two of these things can happen. One is that people have stopped buying branded bottom wear, or they are basically shifting to unorganized. Is there a third thing that I'm missing?
See, I'll tell you from a brand relevance perspective, no, Samir. See, we are very closely in touch with the consumers who are walking into Go Colors and buying, right? So we are very clear whether we are meeting the needs of the consumer who's buying. The consumer who's coming in is definitely buying, and we are very, very relevant. Yes, in the last few years, when the overall footfalls have been low, our new customer acquisitions have been slightly on the lower side, where the actual quantum of new customer acquisitions have increased, but because the base has increased, the percentage has fallen slightly. So what we are also trying to do as an audience is to push up how we can push newer customer, newer audience acquisition, especially in the younger age group. That is what we are focusing on.
Got it. Wish you all the best for the future.
Thank you, sir.
Thank you. Participants, you are requested to restrict your question to 2 per participant. The next question is from the line of Akhil Parekh from B&K Securities. Please go ahead.
Yeah, thanks for the opportunity. And again, my questions are around the competition and the gross margin part. Watching there was an interesting comment made by one of the largest consumer PE funds yesterday on a television that there's a silent shift happening in the consumer categories from organized listed traditional players to say understated agile smaller players basically. And this is happening even in the apparel category, where he cited an example of a few unlisted players like Snatch, Soul Store, Bombay Shirting, Rare Rabbit. These 4 brands combined have added 2,000 crore of revenue in last year basically, while some of the listed players are still struggling. So my first question is, how are we measuring this shift basically? Because I think there's something missing, right? Because as earlier participant also highlighted, last 11-12 quarters, SSG has been mutation. So there's definitely some sales is happening, but that is being taken away by some of these unlisted players. That is my first question. Second, a corollary to it, whether high gross margin is an issue for us basically. Being a listed player, gross margins are very much visible and in public domain and have been on a declining trend for last 5 years now. And we are seeing the similar trend happening in other listed apparel retailer who have a very high gross margins basically, and they are kind of struggling with the sales growth. Yeah, those are the 2 questions from my side.
See, I think you're definitely right. I mean, see, if you compare pre-COVID and post-COVID, right, the number of brands in the retail industry, whether unlisted, whether listed, whether digital, whether offline, has significantly increased. Right now, and I'm speaking this from a generic perspective. I'm not talking about bottom wear, women's wear, men's wear. There is a lot more supply of different brands across different categories of apparel, and the number of players today are far higher than what it was pre-COVID. So that definitely makes an impact on the individual categories. As far as gross margin is concerned, see, we are in a high gross margin categories because of the kind of category we are in. We are in a very full price sales category. So because we are able to achieve and keep that 95% of the sales ratio going, that is very clear indicator in our gross margins. So the gross margins, what we are having is a very clear indication of full price sales ratio and lesser of discounting. Now the question is, whether we should reduce the selling price and push for volume. Even if we had to reduce the selling price, how much would we reduce? If we would have reduced probably by 100 rupees or 200 rupees, that does not really change the customer's decision to buy that product. But then you'll end up taking a gross margin hit. So from a product pricing perspective, like I also mentioned to Risham, we are keeping the price of the product very sharply priced. It reflects in high gross margins because of lower, or I would say negligible discounting.
Okay, so there's no way to kind of do the pilot project where we can kind of cut pricing around certain products and see if that increases the footfall. Because as I said, there is a similar problem with one of the another listed player in apparel segment.
See, from a price reduction perspective, I'm very clear. Look, we don't have to really rework on our pricing. Our pricing is very sharp. And maybe in a few products, maybe we are overpriced by 100 rupees or 200 rupees, and maybe those are exceptions. But largely, I would say more than 90% of our products are very, very sharply priced. So I don't really think that we need to take a price cut to boost volumes. I don't think that is required.
Sure. That's all from my side, and let's wrap up on quarters. Thank you so much.
Thank you, Akhil. Thank you so much.
Thank you. The next question is from the line of Balaji Vaidyanath from NAFA Asset Managers Private Limited. Please go ahead.
Good evening. You mentioned that it's a little difficult to guide on store openings, which is fine, but I'm still unable to figure out why I'm unable to guide on closures, in the sense that, if there are stores which are like double-digit SSSG degrowth for, say, a couple of quarters or 3 quarters, aren't they like a no-brainer call to shut them down? And if so, how many such stores are there which are on the double-digit SSSG degrowth category?
See, I think, we are happy to guide. We are just calibrating the data. And the minute the data is ready on the smaller stores or maybe negative stores, we will definitely pass on the data to everyone. It is not that we don't want to disclose the data. We are just calibrating the data and seeing different cuts of it. And we are also seeing what is the lease period of it before we take a call. So once we have full clarity on that data, we will definitely communicate it.
Secondly, on the gross margin side, with the mix towards the value-added compared to the traditional. So, of course, with given the previous caller's question as well, we have seen the best of gross margins, right? So we can't expect any expansion or anything of that sort from here on.
Yeah, no, see, I think currently at the company, we are between around 62 to 64% of gross margin we are delivering right now. See, from a gross margin delivery perspective, we are very happy. And I don't see any expansion there, right? What will really create an uptick in the EBITDA margins is that our sales improve, our SSGs improve, and our operating cost as a percentage of revenue falls. So I think that is where the work has to be done. From a GM perspective, we are very happy with what kind of gross margins we are currently delivering.
Okay. And in terms of your, capex per store on the incremental and large format stores, suppose if you are present in a very nice area where you already have a couple of, say, small format stores, which for some reason or for negative SSG, you decide to close that. So to find an equivalent, larger store in a similar area, wouldn't that be like a challenge in the sense that the rent per square feet, etc., would be slightly higher than the the smaller format store? Is that right understanding?
No. And see, in such locations, right, we for us, rent to revenue ratio is what we look at rather than rent per square feet. So even if we are taking a slightly larger store, we make a projected revenue for that particular and see what will be our delivered EBITDA on a steady state basis. So it will not be relocating a store from a smaller store to a mid-sized store will not really result in the drop in EBITDA margins. So that we are very careful. That's one thing which I also had explained earlier in the call, that 600, 700 square feet store if I'm opening, from a unit economics, it will not really change much from a smaller store perspective.
And are we changing anything on the agreement side in terms of the locking period, etc., compared to what it was earlier?
No. Our agreements are very standardized. We do the lease from anywhere from 9 years to 12 years, and our lock-in periods are very standardized, what the industry follows. So I think those are going to be very similar to what we used to do earlier.
Thank you very much. Wish you all the best.
Thank you.
Thank you. Ladies and gentlemen, due to time constraint, that was the last question.
No, madam. If there are more questions, please proceed. From my side, it's not a problem. If there are more questions, happy to answer.
Okay.
Please, you can let the call continue if there are more questions. No problem.
Okay. So the next question is from the line of Manjeet Boya from Samya Advisors. Please go ahead.
Hi, thank you for taking my question. First I wanted to understand from the online channel perspective, is that product structurally not suited for that channel from a unit economics perspective, and is that why it's being like such a small share over the years?
Well, I think we have kept that. I think our category is a very offline category because of the colors, the touch and feel, the fitting. I think women in general prefer and trying the product out in a physical store. Like, I remember even during the first wave or second wave of COVID, when our offline stores were shut but our e-com was up, it's not that we saw a sudden boost in our e-com sales. In fact, when the stores started again post the lockdown, we saw a sudden shift in and surge in the store sales as well. So why I'm giving you such an old example is because we've seen this product category is a very touch and feel category. And what we've also seen, right, I mean, I'll be honest with you, we did this customer feedback where we asked the consumer, why are you not shopping at a Go Colors? So that few customers said, your store is very close by. It's faster for the consumer to go to the store, try it rather than wait for the online order to get delivered. So sometimes what happens is when you have a very large network of stores, the consumer can very easily say, look, hey, I'll go to the store nearby and get it. It's much faster than me ordering it online.
Okay, got it. My second question is, as the mix has shifted from about, let's say, 60% on chudidar leggings about 5 years back to, much lower level now, I would presume the fashion element of our portfolio has gone up, right? And typically when I think about it, a higher fashion element brings more supply chain complexity and a higher risk of dead stock in the apparel retail business. So am I thinking on it in the right direction or am I missing something over there?
No, your question is very, very valid. Yes, when you move from chudidar to legging to other value-added bottom wear products, it will not be as core as leggings and chudidar. What you're saying is right. Having said that, even then the category is still largely core. It is not as fast fashion where every season you're procuring and then you might end up with dead inventory. If a legging chudidar stays in season for 3 years, 4 years, maybe other value-added products will be for more than a year and closer to 2 years. So I think the time period of its relevance reduces, but it's not fast fashion. It's not as risky as fashion where you can end up with unsold inventory. That's not really the case. But yes, okay, your question is right. The relevance, the fashion quotient slightly increases when we are talking about non-leggings and chudidars for sure. That goes without a saying.
Okay. And my last question was on the inventory days. We have seen over the years, and I think I've read your comments on it over the last few years since you are listed. But, I see some apparel brands who can work with a significantly lower, inventory day number, right? So what is different in our category? Because that's one thing which sort of keeps our return on capital quite suppressed overall despite having reasonably good margins. Right, even in the best of the years, we have done only 20%. So that was the question. Sorry.
Yeah, I think, look, we've studied our sourcing model and our product portfolio. We feel on a steady state basis, 85 to 90 days of inventory is what is apt from a product perspective because we have so many sizes, size and colors. It will be very difficult to operate below 85 or 90 days. Yes, there is room of efficiency. We will keep improving, but that is that number. So currently we are at about 114 days, and reasons why inventory has slightly gone up is because of muted sales. Your inventory days has increased because of muted sales, which I think in the coming quarters it will stabilize. We've been very sharp with inventory. So this is a very temporary increase in the inventory days what we are seeing in this quarter. It will stabilize in the coming quarters to come. But from an efficiency perspective, I think we can bring it down to about 85-90 days, which we have done it in the past, and I think we'll be able to bring it down to that level. Now, whether going below 85-90 days for our kind of category and our kind of SKUs, little tough to go below 85 days.
Got it. And lastly, related to working capital, is there any lever we have on payable days, or is that, we get a better pricing and that's where the payable days stay in the longer run?
Yeah, we get a better pricing. That's why we keep our payable days low. And that reflects in the gross margin.
Okay. Thank you for taking my questions.
Yeah, thank you.
Thank you. Ladies and gentlemen, as there are no further questions, I would now like to hand the conference over to the management for the closing remarks.
I'd like to thank everyone for being part of the call. We hope that we've answered all your questions. If you need more information or any other questions, please feel free to contact Mr. Bhinder from SGA, our investor relation advisor. Thank you so much.
On behalf of Go Fashion India Limited, that concludes this conference. Thank you for joining us, and you may now disconnect your lines.
If you found this video helpful, please like, share and subscribe to Concall India for latest upcoming Concall.